The hospitality space once again. Patanjali Keswani, who's the chairman and managing director at Lemon Tree Hotels, joins in to discuss the impact of GST cuts, more importantly, the outlook for the second half of this fiscal year. Thanks a lot, Mr. Keswani, for joining in. The obvious question, how's the business been post GST cuts, and has the lack of input tax credit impacted performance for you?
Well, I think, look, there will be obviously an uplift in demand because the price comes down. But on the other hand, there will be a loss of input credit. So one can only hope that the uplift, the flow through from revenue uplift, more than cancels the loss of input credit. And I think input credit should have been retained in an industry like ours, but unfortunately it was not.
Got that, Mr. Keswani. But what kind of quantifiable impact would you have, due to the lack of input tax credit?
We own a lot of our hotels, number one. Okay, and input credit matters either way for us. The reference you are making is for management fee income, but the reference I am making is for ownership. So when I look at our business, about over 50% last year was above 7,500 rupees as an average rate, and about 50% or a little less was under 7,500. Obviously, there is a change in pricing this year, as it happens annually. So I would reckon about 40% of the business that we get is going to be impacted by loss of input credit. Okay. If I quantified it on a revenue basis, I would estimate it would be in the range of about 1.5% to 2% of revenue. Say 2% of revenue. So that's the impact on margins. But will your revenue go up by more than 2% because of this fairly significant drop in GST? Well, I would hope so. And if that happens, then this becomes, one cancels the other.
All right, so about 100 to 200 basis points impact on the margins, but if that's offset by higher revenue because of lower prices, that would be a positive for you. But the second half, it's a strong season for the hospitality industry. How's that looking for you?
Q2, you had a good last year, and therefore Q2 this year, in relative performance to Q2 last year, would not have been anywhere near as good as Q1 was to last year Q1. Now, when I look forward into Q3, the interesting thing is what affected Q2 will not affect Q3 this year. For example, there were a lot of festivals and so on last year in Q3, which occurred this year in Q2, which deflated demand this year in Q2. I hope I'm making sense to you. And so when I look at Q3 this year, Diwali, Dussehra, all of it put together has occurred and will occur in October. Okay, so that gives you what's called a clear November this year, whereas last year Diwali was towards the end of October and the impact was felt through in November. Keep in mind that in our industry, I would say the 3 most critical months, 3 to 4 most critical months are after Diwali till middle of December, and after January 26th till middle of March. These 3.5, 4 months account for 50% of your revenue. Because it goes gangbusters then, demand from every possible segment. So this year we are going to have a very, very good H2 compared to last year, primarily driven by the fact that you have this enormous upswing in November this year, which you did not have last year.
That's a little tricky answer there, Mr. Keswani. Let's keep things simple though. How much higher will growth be in the second half of the year compared to last year?
We had a very, very good Q1, for example, the industry. By the way, I'm talking industry. And I think 18 to 20% was the growth. So I would not be very surprised if we did not at least do mid-teens growth this H2, tending towards late teens versus last year.
All right. And what are the new properties that you're opening? All right. Just before we let you go, what's the update on the restructuring, sir?
You will have to wait for 2 months. That's being discussed, but there is plenty of very interesting stuff happening in our company, and that should be out by the end of this calendar year.
Wait, you said you have to wait for 2 more months. Could you give us some more details of the interesting stuff?
We are looking at multiple things, one of which is, of course, the listing of Fleur and a pre-IPO kind of valuation. So we will look at raising some money in Fleur. We will also look at the route to listing Fleur, which is it a direct list or a demerger? Third is we will be looking at certain large acquisitions for our company. And I mean, parts of it you've already seen. We've acquired, the 550-room Aurika plot in Delhi, which is very, very important for us. And there are many, many more things happening. Can't tell you right now, but for me, it's going to be a super busy Q3 because of so much happening there.
Okay, all right, Mr. Keswani. Appreciate you joining in. Always a pleasure talking to you. Look forward to catching up with you rather soon. Well, time to slip into a short break, but as we do that, a quick note for our viewers. As you can see on the screen, there is a money control stock score just above the line graph. This is a score assigned to each stock based on Money Control's multi-factor algorithm. It is calculated by analyzing over 40 parameters, including both current and historical financial statements, price charts, and technical indicators for each stock. Each of the individual parameters considered for calculation of the 4 factors are score, which is then aggregated to arrive at an overall Q factor score, G factor score, V factor score, and T factor score. Remember, this is not a buy or sell recommendation. Any investor, viewer is advised to carry out necessary diligence on their own or through a certified registered financial advisor for investment decisions.